Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day. Today's stock is Johnson & Johnson. The symbol is JNJ. We'll discuss, should we pass or should we play? Hello, everyone. My name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
Well, Lindsey, we have a few interesting charts to look at this week. In the S&P 500 index, it looks like we're coming close to that all-time high. What do you see going on in the markets this week?
Yeah, I mean, last week was a really great week. We just got, I think, what turned the S&P 500, which was slightly negative as we were looking at it this morning. I think what might have turned that green is we got TSA traveler numbers. Over 800,000 people traveled on Sunday. That's the highest number of travelers, TSA in the airport, travelers in the airport since the pandemic started. So that's a positive. And then, Brian, looking at just some of the broader indices in general, what caught my eye in the last couple of days, especially, is the small cap indices. I know you're going to pull up a chart of the IWM, which is the iShares Russell 2000. And today it's leading the markets. Last week it had the best week out of all the markets that we saw. So it was up 6%. The S&P 500 was up 2.5% last week. So outpacing performance there. And really, it looks like, looking at this chart here over on the right-hand side there that you're showing, it really kind of took off in the month of August. It's, last week had the best week since June, reaching a new high, not all-time high, but new high here since March, I believe. What do you make of the chart?
Well, yeah. Okay. So first of all, let me just run back, and I'm going to look at the SPX chart, and then I'll come back to the IWM, the Russell 2000 iShares. When we look at the SPX, this line, we actually drew that last week, so I didn't adjust that line whatsoever. We just talked about this little gap right here in the S&P 500 index, and we actually broke out of that, and now we're sitting in the middle of that channel, and we've kind of filled that gap. So in general, that's a good sign that we might be going towards that new high. And as you mentioned, obviously it's always good news in the markets if you do set a new high, and then you got to figure out where the next stopping point may be. Now in the Russell, I think it really helps when the small cap index is leading the way. That's usually some strength in the marketplace. And we see here for the first time almost since the pandemic, we're above the 50-day, the 20-day, the 200-day. And we saw a lot of consolidation here. A lot of times when you see this many days in a row where the market just basically stays flat, what has a tendency to happen is it just kind of creates a springboard, and we're either going to spring to the upside or spring to the downside. And here was a point of resistance right here. I'm going to kind of highlight this. This happened back in June, and we just couldn't really get past that, and we did. So now, who knows what's next for the Russell 2000, but it's a great thing to see the small caps leading the way. That's usually a good sign just overall for the markets, in that the smaller companies are actually doing all right. So they must have had a decent earnings this quarter in general, and that's propelled the Russell to new highs since the March pandemic, I should say. If you notice that is a new high since the big downturn overall. All right. With that said, let's get into today's stock. We're going to talk about JNJ, and what are we seeing there, Lindsey?
Yeah, before I get into the stock, we're going to talk about J&J Johnson & Johnson. Just a reminder to all of our viewers that Brian and I will take your questions at the end of the show. So feel free to type them in the chat box over on the right. I see a lot of you are already being chatty. Thanks for the heads up on the echo situation. I think we've got that fixed. But always let us know when we have little issues like that. So here we go. We've got the chart of J&J up here. And J&J, we started thinking about, Brian and I were thinking about, the coronavirus vaccines. We have in the past done other plays around this in the healthcare space, where you can kind of benefit from the potential that a vaccine or any type of treatment would have on the sector in general overall. I know people are pretty optimistic about us getting a vaccine. The timeline for that vaccine is still uncertain. And there's a lot of different ways that you can play this event. But we wanted to take a look at J&J because there's a lot of different companies that are developing vaccines for the coronavirus, J&J being one of them. They are a little bit further behind in their human trials of the vaccine that they do have versus some other companies, say a Moderna or a Pfizer. They're a little bit further ahead, a couple months further ahead. But what caught our eye about this was, well, last week we heard that the government is going to give them $1 billion for their first, for 100 million vaccines initially. So that's positive. They're getting government money. They've also received some money to work on the development of their drugs for a vaccine. And so that's positive. But also what was interesting is we saw a report out from Bloomberg. Bloomberg Research was really talking about, like I said, J&J is behind in human trials. They're going to get to their later stage human trials in the fall of this year, while you've got some of the other companies that are currently already doing that and will get results from those trials in the fall. J&J is behind the game, but they trade in sympathy with the results from some of those other trials. Anyway, Bloomberg was out and they talked about, their research analysts talked about how their non-human or animal tests on the coronavirus vaccine that they're running are showing some really good early signs of success. And they actually, what they said is their primate data for the vaccine looks the most compelling, more than AstraZeneca, which they see coming in second place and also is ahead of J&J in development. But they were really positive on this. And these guys also reported earnings in mid-July. So not only are they developing this drug, it seems to be chugging along in a nice way, but also from a fundamental perspective, looking at their second quarter, while their consumer business was surprisingly a little weaker than expected, their medical device business was really strong, and their pharmaceutical business came in line to being slightly better. So that was good. These guys do have a solid balance sheet, and they're part of the Dividend Aristocrats Index, which means they've increased their dividend every year for at least 25 years. In fact, if you go back and look at history, they've increased their dividend every year for 57 years. They just recently announced the increase this year. All the other companies they're competing with for these vaccines and in this space, including a Pfizer, Moderna, AstraZeneca, Sanofi, they can't say any of that. Pfizer used to be an aristocrat, but back in the great financial crisis, they had to cut their dividend, so they're no longer in the same boat. Though they do have a pretty solid dividend. All of those guys actually have decent dividends. We feel like J&J dividend could be a little more secure. So we like that about it. It also has like I talked about with their second quarter earnings, they have diverse business lines too. So that helps from a quality perspective, even if they aren't the first to market with a vaccine. And we just thought this was an interesting way to play the coronavirus vaccine and treatment, given the company's valuation as well. So some of those other companies that I just named, they have, skyrocketed in price to the moon, and their valuations are much higher. So if you look at a J&J here, let me just pull up my chart. I was looking at the valuation, and J&J is trading at 17 times, which compares to its historical average of 16.5, so a little bit of a premium. But you look at AstraZeneca, which is trading at 25 times. Its historical average is like 19 times. So relatively, from a valuation perspective, it hasn't run up as much as some of those other guys. So we're kind of thinking there's an opportunity here, and we expect to get good news across the board on vaccines going forward. And even if a Moderna, who is leading the race here, comes out with some negative news, that's going to be a positive for J&J. That means that they could their vaccine could be the one that doctors and hospitals use the most. It brings them up in the race. But if there is good news from Moderna, I do think it could be a sympathy trade where J&J does well also. And either way, longer term, healthcare has done really well, and they've got a lot of other things going on. So Brian, that's what I'm seeing in the stock here. It's been kind of trading in a wide range from May through August. But it is, it's trading. What's the blue line you got showing there? That's
the 20-day.
That's the 20-day. So it's right on the 20-day, and then the red line is the 50-day. So it's nicely above that, and the 200-day.
Yeah, it's been such a news-based stock that's part of the reason for the choppiness recently. It's not necessarily trading on the fundamentals. It's been trading a ton on the news overall. And so I just almost called the chart blah when I look at this. I mean, I don't know if that's a technical term or not, but I think that term does apply. And don't forget to put in your questions. If you have any, we'll try to answer them at the end of the show. But let's jump on into the actual option strategy today. So Lindsey and I were chatting just in general, just about these types of stocks that are in the race for the vaccine. And as Lindsey mentioned, not only is J&J in the race, but they have fairly decent fundamentals. And we see that there is a little bit of room as far as the chart is concerned. We actually got up to a high here at the beginning. Look at about mid-April it basically just skyrocketed from the bottoms all the way up to the high. So it still has a little bit of room to grow to get to that all-time high in J&J. So what's one way that we can play these type of strategies? Now, a lot of people will look at options and they say, well, I want to use options to try to speculate on that underlying stock. If you have a couple of underlyings that you think might make that vaccine and might actually get there first, one way to do it is to actually use options to lower your risk as opposed to buying 100 shares of the underlying stock outright. And when you buy stock outright, you have the risk that the stock price can go down, and the stock could go all the way down to zero. And in J&J's case, it's at $148. To buy 100 shares, that would be $14,823. And don't forget, if you have commissions or what, you always want to add that into your plan. But what we're going to look at doing is saying, well, if J&J is one of the stocks that you might be thinking about buying, what's a way that I can do it and I can limit my risk? Now, as always here on the Stock Play of the Day, we're just trying to learn, and that's why we talk through these strategies so much. But if you go into the Ally Invest Options Playbook, in the Rookies Corner, we actually talk about buying leaps as a substitute for buying the stock outright. So I'm looking at this as, if I buy a long-term option, and that's all that really LEAPS actually stands for, it's a marketing term made by the Chicago Board Option Exchange, but if I buy a long-term option contract, I am saying that I want to buy something that represents a lot of the stock price movement. So I want to go deeper in the money, and I'll pay attention to what the delta is telling me. The delta should tell me approximately how many shares of stock that option contract looks like. Now, I'm saying, let's think about this. If you were considering buying 100 shares of stock, 100 shares of Johnson & Johnson right now would be $14,821. You take that price, times it by 100. Or we're going to go out to January. We're going to give ourselves some time here. Oh, got wrong one there. 1 second. We're going to go all the way out to January, and we're going to go a little bit deeper in the money. We're going to go down to the 80 delta. Like I said, we're going to pay attention to that delta. And the 80 delta option contract on the 130 strike is trading for $20 overall. That gives us 158 days. It's a fraction of what the overall cost is. We have something that acts a little bit like the stock. The total cost, if you paid the ask for it, would be $2,035 plus commission on that trade, and that would be your total risk, would be that 20 points, $2,035 overall. So this will be the official paper trade for this week. And if you think of it this way, if I'm going out further in time and I wanted to look at maybe some of the other stocks to go along with it, this would allow me to take that same capital that I would if I just bought 100 shares outright, and I could buy a couple different of these companies to give myself a potential if one of them makes it to the vaccine cure first. But this is one way that you can approach it. You're trying to use the option contracts as a substitute for owning the stock outright. And part of the reason why I'm talking about this trade today is that implied volatilities have finally started to come in on a lot of the stocks. We finally see the VIX index. It's down below 25. It's trading at about 22% implied volatility. That's the volatility index that actually tracks the stocks in the S&P 500 index. And in Johnson & Johnson, during the big downturn in March, we saw the implied volatilities on a 30-day basis. It skyrocketed to about 68%. And the low for the year was around 14%. So right now, if we look at the implied volatility of the 30-day weighted index in Johnson & Johnson, it's right around 19% implied volatility. We go all the way out to the January expiration, we're seeing at about 23% implied volatility. So for the first time in these markets, as we're setting new highs, we're finally seeing some of the fear come out of the marketplace, or you could also say some of the implied volatility come out. So that makes it a little bit more feasible to look at longer term options as a substitute for the stock, because you don't have to pay up for all that time premium. So if I look at the 130 strike call option, we have an okay market on this. We're 2005 by 2035. Now, this is one of the bigger downsides of buying longer term options instead of the stock, is the bid-ask spreads are a little bit wider. Obviously, in a stock like Johnson & Johnson, you're going to have like 1 cent wide bid-ask spreads. But when you're dealing with leaps, you're going to have to work the order a little bit. But you do have decent open interest. We have 3,000 3,111 contracts are out there that are open, that are trading. So maybe you can work the order a little bit. But if it wasn't for the wide bid-ask spreads, if you weren't dealing with that situation, buying leaps as a substitute for actually buying 100 shares of stock outright would be extremely popular. But you have to deal with the bid-ask spreads, and that's one of the biggest concerns about buying longer-term options. But with that said, we're only putting up $2,000. Of that $14,800, if we bought 100 shares outright, the total cost of this trade would be around $2,000 plus commission. So I'm going to officially make that our paper trade. It's a very simple, straightforward trade, but the concept behind it is more important than anything else, right? We want something that's going to act like the stock. We don't want to put up all the capital of the stock. And now we're going to have limited and known risk on this entire trade. It will be that 2,000. If we filled at the midpoint, let's call the midpoint, let's call it 2020. That just happens to be the year, so why not? That'll be an easy limit to remember. So we're going to try to work the trade. Midpoint fill is never a guarantee, but we're paying $20.20 for this. So this would be $2,020 to put on this trade plus commission. That would be my max risk on this entire trade. If I buy it outright, if the stock goes up one, we got an 80 delta. That means that this option contract should go up by about 80 cents. If I bought the underlying stock, that's in theory. The delta is always a theoretical number. But if I bought the underlying stock and it went up one and I owned 100 shares, well, I'd expect to make $80 on this option contract by looking at the delta. I'd expect to make $100 on the stock. I would expect to make $80 on the option. So looking at this as a surrogate to buying the stock, interesting way now that implied volatilities have came down to look at these fairly expensive stocks, right? $148 stock or some of the other underlyings that are in the race for the vaccine. And you limit your risk and you get the upside potential of owning that just like you would if you own the stock outright. So I'll just throw up the profit and loss graph here real quick like. So here's the difference. If I buy this option contract, I have limited known from 130 on down. Can't lose any more than that $20.20 that I paid for it. I have substantial upside from this part on up. As we go up, we have all the upside, just like if we own the stock outright overall. So interesting way to look at these underlying companies that are in the race for the vaccine or the cure, or something positive that can help out the world today and in the environment that we're in. All right. Well, I see the chat box is kind of going a little crazy over here. Lindsey, do we have a question you'd like to start with first?
Yeah, we've got a lot of chatter, which is nice, and a handful of questions. First, Hitman asked, an options contract is not ownership, so how is the value recalculated? Completely green to options. Dude.
All right. It kind of does. It kind of does. Let's put it this way. So if you own an option, you don't own the stock. You own the right to buy the stock. So one of the biggest things that you need to learn when you're first trading options is how they are priced and why they are priced the way they are. So a lot of people, if we're looking at this trade, would think to yourself, well, why are you going so deep in the money? This is a quote unquote expensive option. But if you're using it as a surrogate to the stock, it's way less expensive than the stock. So how do I develop realistic expectations as to what that option can move relative to a stock price movement? And that's where the delta comes in. So to answer the question, what I would say is I would assign a chapter to read about inside the options playbook. So inside the options playbook, you read about Meet the Greeks. And one of the first Greeks that we're going to talk about is delta. And that will give you a theoretical, more realistic expectation as to how that option would move relative to that stock price. But obviously, one of the biggest downsides on options is that it does have an expiration date. We're going all the way out to January, but it does have an expiration date. And after that date, that option contract ceases to exist. So overall, it's just an interesting way to address that question or to look at it is to learn a little bit more about option pricing. And I think that actually gets ignored in a lot of basic option courses overall. I think pricing is the biggest difference between an option contract and actually owning the stock outright. So great question overall. Anything else that we have?
Yeah, so that options playbook is a great resource for any questions you have on options, and it's right online there. So you can find it, or you can buy the actual book on Amazon.com that Brian authored. There are a couple other questions. One is what's the type of margin J&J is going to receive from the vaccine at potentially $10 a dose, which I think you're making an assumption, Chris, that it's going to only be $10 based on a $1 billion and 100 million doses. So I get where you get the $10 from. Actually, the government isn't loaning J&J the money. It was I believe it's a grant. I have to double check that, but I don't think they have to pay that money back. And they've actually said that they're going to give the vaccine to consumers at no cost. However, hospitals and those that are administering the drug can charge for that, charge a fee for that service. So it's TBD on the margin that they'll receive, because like I said, they're going to charge it at no cost, but they get to keep that $1 billion. I'm pretty sure they get to keep that $1 billion from the government, plus a couple $100 million that they received for development as well earlier before the $1 billion announcement. And the government has made similar deals with other drug dealers as well. So that's just something to keep in mind. It's a valid question, though, because margin is everything when you're looking at a stock. Margin expansion is a positive, but they'll have that $1 billion. Another question is on the macro side. What do you think from Tomato Joe 11? What is the best way to diversify your investments? I think that in this current environment, you hear a lot of people talk about the barbell approach, and Brian, feel free to jump in here too if you want. I think, diversification in general means having exposure to various types of sectors or even asset classes. But if you're just within the stock market, different sectors is beneficial. But I've been talking a lot about a barbell effect because the move that you're seeing in the small cap index that we pointed out at the beginning of the show, and other things like the move in silver, perhaps. There are, and the move in value and some of the other cyclical sectors, there's some early indications that those types of sectors, which usually do really well at the beginning of an expansionary period, there's early indications that maybe we're getting into that expansionary period. or perhaps just the worst is behind us. So I think having some exposure to those areas is good, but also then having to offset that with some defensive sectors like healthcare. Another reason why J&J is a great company in an awesome sector that is defensive. And like I said earlier, they have that dividend that they've paid on a historical basis that you can count on. But also, stick with some of the things that have done really well, like growth and technology and some of the momentum stocks and sectors. Then you have like a pretty nice diversification there. But as always, we say, don't set it and forget it. Make sure you're monitoring your investments at all times. And anytime there's a major change or shift in the economic environment, the market, the government policies, you got to kind of take a second look at what you own and see if it still makes sense. I don't know, Brian, do you have anything to add?
Well, I don't know how I could add too much more. That was a very detailed explanation overall. I mean, one of the other things, though, that I mentioned when we looked at the JNJ trade just now was one way that you can leverage your portfolio to allow you to buy in a few other different sectors is to look at deeper in the money leap options. The biggest downside, though, is once again, it has an expiration date. Even though we're going all the way out to January of next year, we still have an expiration date. But that's one way that you can diversify a portfolio. And the only time where I wouldn't want to be doing these type of strategies when the marketplace was at extreme volatility, because you're paying up for that. You have to pay up for those option contracts. One of the things, like I mentioned today, that makes this trade in Johnson & Johnson a little bit more interesting, once again, it's just a paper trade though, is that the implied volatilities have came down in that underlying stock and in the market in general. So just an interesting way to diversify is to try to use options to limit your risk to the downside, but also give you some exposure to those underlying stocks that you want exposure to.
Exactly. And Brian, I know we're basically at time, but let's try to get one more question in here. Stein 3D asks, with leaps, with a lot more time for the stock to move, are you using a stop loss, or how do you work around the stock moving against you? Part of your upfront stock forecast.
Well, part of the reason why we're doing this trade is that it is a limited and known risk. Like we said, if we bought the underlying outright, it was around $148 stock. That's $14,000. If I buy this leap option, I'm buying an 80 delta, but I'm limiting my risk to that $2,000 overall. So part of this is I am limiting my risk by buying the option contracts. And a lot of people don't think of it this way when they're thinking about options, and that they're thinking I'm using options to leverage my portfolio, but not in this case. We're talking about buying 100 shares of stock, and what's that alternative? It's to buy one option contract that represents 100 shares, but has a higher delta. Now, could I go out and put a stop loss in on the option and say, well, if I'm down $500 on this position, or I'm down whatever number you would want, and I want to get out of it, definitely I could do that. I could trigger it off of the underlying stock price if I wanted to. You can also put stop losses on option contracts outright if you would like. So you have those tools available to you. The biggest thing about the options and the leaps, and this is probably the biggest disclaimer overall, or headache, I should say, of buying leaps as opposed to buying the stock, is dealing with the bid-ask spread. So you're always kind of working your order, especially on the longer-term options. But Johnson & Johnson is a very liquid underlying, so you're not as afraid of it as you would be in a less liquid underlying. The bid-ask spreads would probably get a little bit wider. If the underlying stock isn't as liquid, then the option contracts will also be less liquid overall. But yeah, you can do. So in short, you can put a stop loss in, you can set an alert on your computer. So when the stock gets to the price, you check it, look at it, and see where your option's at. Yeah, all that is available in the options marketplace. Great question.
All right. Well, that'll do it, Brian. That's all we got time for. I'll just remind everybody that you're going to do your Friday noon stock play of the day overtime show on Friday at noon, reviewing this trade, checking in on it, and making any suggested changes or adjustments if necessary. So everybody should tune at noon on Friday to get an update on this paper trade. But yeah, that's all we have the time for, Brian.
All right. So to make sure you get all the alerts, please click subscribe and ring that bell. And then this Friday, noon Eastern time, you'll get an alert for the stock play of the day overtime. Thanks for coming, everyone. See you soon.